let's be clear, Bitcoin is an international asset.
We are spending like drunken sailors.
Bitcoin is the only economic entity where the supply is unaffected by the demand.
If you want to preserve your wealth, you have to convert that currency into an asset that's scarce, desirable, portable, durable, and maintainable.
All right, welcome back to Scarce Assets. Scarce Assets is a bi-weekly podcast dedicated to exploring the investment landscape shaped by the paradigm of scarcity as the ultimate driver of value. As traditional investments struggle to provide real returns and fiat currencies lose their appeal due to debasement, our show provides a forward-looking lens on how investors can preserve and grow their wealth in the 21st century. So this week, we have the pleasure of being joined by Peter Groff, chairman of Argo. So Peter, you are one of the founding investors and currently serve as the chairman for Argo, a precious metals investment platform that enables secure and digital access to physical gold. With over 35 years of experience in the financial services industry, Peter served as the chief executive officer of Sprott for 12 years from 2010 to 2022. During that time, he drove the growth of the fellow Sprott family company from $5 billion to more than $20 billion of assets under management. Peter is a CFA charter holder and earned an honors degree in business administration and a master's of business administration from the Richard Ivey School of Business at the University of Western Ontario. Peter, thank you for joining Glenn, Tim, and I today. How are you doing?
I'm great, thanks. And thanks for having me on the show.
Thank you. We appreciate it. So I just shared a little bit about your bio. There's obviously a ton that we could unpack there in over 30 years of your career in traditional finance and precious metals, but maybe the best place to start would just be sharing more about your time at Sprott and now leading Argo. Could you just share about your background, how you transitioned from traditional finance and ultimately finding gold and precious metals as a attractive asset class that you wanted to anchor your career to?
Sure. Well, it wasn't very well planned. When I left university, I joined a bank out of business school. I quit that job before I started, and I started in with a friend of mine at a small brokerage firm in Canada, and I was handling futures and options. So that was my first exposure to gold. I was quite young. I was one of the youngest traders there. I kind of had a math background and finance background. And I was one of the first young guys to be trading gold futures and gold options at the time. So I kind of got an early education in gold. I then went back, did my MBA, and became a banker and spent many years heading a couple of different investment banks and covering the gold sector from a corporate point of view, a corporate and a banking point of view. And one of my great clients in those days was Eric Sprott. Eric had founded an investment firm of his name, and he asked me to come over and be the CEO in 2010. Gold had just had a phenomenal 10-year run. Eric had made the call of a lifetime, so money had been pouring in. And then we went through basically 6 really tough years when gold was doing its pullback and the Chinese super cycle ended. And it was tough to build Sprott in those days. And we started very slowly. But there was nobody else really solely focused on precious metals. And over time, we won fans, both institutionally, retail, a lot of U.S. investors. And it was one of my proudest moments, really sticking it through and building Sprott to be the powerhouse that it is now. So I retired a couple of years ago and started on a few other gold investments, including Argo.
Awesome. Appreciate that background. It's fascinating. We'll get more into the conversation in a bit, but I think it's interesting. I didn't know that you started on the derivative side and trading gold futures and options, and now the work that you do at Argo is more focused on the physical asset versus the derivatives. And I know we'll talk a lot about paper claims on the price of gold, but just fascinating to hear that journey. And now you're focused on physical security of the asset versus the derivative market. I'd be curious to just dive in a little bit more into, you mentioned you joined Sprott. Given the relationship that you had with Eric as a client of yours on the banking side, and how did Eric see the opportunity in gold, that bull market? How did he know to position himself? And then ultimately, what was it like for those couple of years where you joined? You mentioned it was just tough working through the bear market. What did you learn from that experience?
Well, Eric, being based in Canada, we have a natural affinity to natural resources, and so we were always pretty adept at investing in the gold sector. And Eric was big on junior gold companies, probably for 15 years before he founded his own investment firm. He made one of the best calls I've ever seen, which is in the year 2000, he put a big banner up for his clients and it said, "Get out of NASDAQ and get into gold." And he timed that perfectly from what I can recall, about April of 2000. And his premise was NASDAQ and the money printing had just already gone so far at that time that you needed to take respite in a hard asset. And gold was very cheap, as I recall then, probably less than $400 an ounce. And he timed it absolutely perfectly. So that built Sprott up very quickly after that, 10 years of incredibly good results. And I joined after those 10 years. So it was kind of just when it was going into a period of a correction, what I'd call a correction. And it was a pleasure to join Sprott because it had financial capacity. It had, $4 billion of assets at the time. So it was no small firm. But to transition it into a multi-product company in gold, and our star product was the Sprott Physicals, physically backed. Even in those days, we were talking has to be physically backed, has to be fully allocated, has to be, able to be audited. And at that time, there was a lot of concern about the GLD, that the GLD was using contracts, that it didn't have all the physical gold. And that's how we built the Sprott Fizzes up to be a global competitor.
Yeah, no, that's fascinating. So how does that tie in? I think Glenn had some questions, but maybe could you get us up to speed, Peter, just on where the market is today? It's a timely interview just because gold is approaching $3,000 per ounce. I think the all-time high was last Monday, the 10th of February. Don't know the number off the top of my head. Maybe you could tell us, but what's driving the surge in gold? And Glenn, I definitely want to get into some of those ideas you had around the paper markets too.
Sure. And I do think there's two great reasons for doing the interview now. The first of those is the overall gold price performance, almost touching 3,000. Everybody says, isn't it getting expensive? Hasn't it run too far against real interest rates, which the Fed has raised? Isn't it extended against the US dollar? And all those things are a little bit true. The sentiment is running very hot for gold. And it usually has periods of small corrections. But what's driving it is the debt and the deficits. Pure and simple. People are increasingly nervous about the U.S. Treasury and U.S. government that's running a $2 to $3 trillion deficit at a time when the economy is doing very well. And against that, an almost $40 trillion debt pile, which is now running interest as the highest single expense. And it just seems to be out of control. And I think that those investors that have now, in a very real way, experienced purchasing power declines are saying, I need protection. And, gold is no longer this gold buggy, inflation kind of buggy thing to buy. This is a real insurance asset that I need for my portfolio. And I think that's what's driving the relentless, gold price increases. And ironically, one of the largest components of buying is governments themselves. So central banks are buying gold, and you can't go for very long against the old adage, which is don't fight the Fed. If don't fight the central bank. If central banks are buying it, then households are going to be adding it too.
Yeah. And so one of the things I've been reading about in the newspaper a lot, I'm not a gold expert, so I'm trying to wrap my mind around it, is we're seeing a lot of demand for physical settlements in the gold markets. And I've also seen, so I'm based here in London, and the Bank of England, normally it takes a few days to get delivery of physical gold. Now they kind of saying 8 to 10 weeks or something like this, which always kind of gives one pause for thought. If you go to the bank and say, I want my money, and they say, well, there's a delay, there's a pause. It doesn't matter if it's a cryptocurrency exchange, just a normal bank, or a gold vault. It's like, hang on a second, what's going on here? They've got these kind of excuses about truck drivers and the weight of the gold and whatever. But I mean, that's always the case, right? So, and also what I'm seeing is that the COMEX gold, the amount of physical they have has spiked up a lot, right?
Yeah.
And so there seems to be this sort of transatlantic kind of part to this. And then I've also heard stuff about like the Shanghai gold market and physical delivery there, and kind of how all this ties into sort of geopolitics and kind of concerns about, I mean, we obviously all know about what happened with Russia seized assets back in 2022, things like that. So just if you could give us your understanding of kind of what I've painted as, very broad brush kind of outline there of just snippets that I've heard here and there. Could you kind of decipher what's actually going on here?
Sure. Well, gold is a very liquid asset. It trades somewhere between, depending on how you count it, 100 billion to 200 billion a day. It makes it the world's third most liquid asset behind US dollars, US Treasury bonds, and possibly euros. So it's in there at 3 or 4. Many of the trading contracts for gold are not physically backed or totally physically backed. There's 2 major sources of those paper contracts. One is the futures and options market on primarily COMEX. And the second is the London unallocated gold pooled market, which are basically commercial banks trading gold contracts that are conceptually backed by physical, but you don't really know how much, because you don't know how much physical the bank puts behind their commitments to deliver physical. So both those markets are levered in one way or another. And what you've got in the short term is, with the tariff threat coming in and an increasing divide between nations moving materials between themselves, gold investors, I think, rightfully get concerned that I want my gold closer. I want my physical closer to where I might need it one day. And so COMEX, which is this massive levered market on gold, paper claimed gold, is rightfully stocking up in case they need to deliver against those contracts. So I think the exact number is moving from 15 to 30 million ounces or something like that. And it's, I think, understandably taxed the system for gold delivery. I mean, you'd be taxing the fleet of Brinks trucks and 747s in secure holds that can even move that gold. So I guess it's probably not surprising that the delivery times are widening out. But in an investor's mind, I think this strikes to the heart of it. why do I want to own an asset that protects me from the financial system by owning it in a levered way through the financial system? It just doesn't make any sense. It's like you're buying insurance against the insurance company from the insurance company. It's,
Yeah.
and so I think investors are kind of starting to separate church and state and say, I actually want my physical. In my view, that's a healthy delevering from the paper gold system. And maybe the long-term impact is to put a premium on physical gold that can be duly delivered quickly. So, and maybe paper contracts are going to start trading at a bit of a discount, and that's kind of what's happened with the contango and the reversal of the normal, futures delivery system, where the spot months are leading the out months.
Yeah, because what I've read, so I started researching this topic, and I mean, there doesn't seem to be anything reliable in terms of a sort of a very verified source. But I've read that there could be as many as 100 times the paper claims as there is actual physical gold, right?
Yeah.
And so, obviously, in a commodity, so this whole show is about scarcity, right? But you take something that's scarce like gold, verifiably scarce, right? And then you inflate its sort of supply in inverted commas by 100 times, right? Over, I don't know, over what period those paper claims on gold have come into existence, but I imagine it's decades, right? And I just wonder, I mean, that's a huge amount of leverage, right? Like if there was something were to happen where everybody wanted physical at the same time, so there was sort of a metaphorical run on the banks or a run on physical gold, what do you think would happen? Because obviously there's not enough to fulfill all these claims. So it would be like there would be defaults, right?
Yeah, I think that, look, it wouldn't take 100 to 1. I personally believe the ratio is lower than that. I think it might be 100 to 1 in the trading markets, but if you're
Okay.
actually talking about longer term ownership of gold, I think there's significant leverage, but it's probably a lesser ratio. But let's just say it was 10 to 1 for arguments. Even if you had a squeeze on a 10 to 1 leverage ratio for delivery, you'd have some defaults, people that couldn't deliver, financial institutions that couldn't deliver the physical in the allotted time, traders who would hold them accountable, investors who would hold them accountable, and you'd get some breaking of the shorts. So does it mean that the global delivery system for gold, which has traditionally been commercial shorts, is finally going to get squeezed? I do think it's going to get a little squeezed here. So,
Okay. Okay.
that is what happens when a scarce asset is overly shorted and overly, portrayed through paper claim.
Yeah, I have a question, Peter, just on what you just described in the past 5 minutes or so. Are those predominantly sovereigns and central banks that are asking for physical gold to be delivered, or are there other investors that are doing this now? Like, what are you seeing? I know you said this is partially in response to tariffs. Are there other things that are driving this as well?
Well, I would say by and large the whole institutional and investor custody system, if they have clients that have asked for physical gold, are perhaps no longer willing to take a paper gold delivery commitment by a bank. They want the physical. So I think just in general, people want it closer to their own pockets, to the clients they've promised it to. I don't know if central banks always demand physical. I would think that based on the whole US using the SWIFT system to punish foreign countries for not adhering to its principles, I do believe foreign countries probably want the gold in the nation. that they've purchased, so they probably want physical. And I just think in general, the preference is going to be to move to physical now.
Yeah, because it's sort of like, it reminds me of kind of the history of money, right? Because, I mean, essentially, we had like a kind of a classical gold standard until sort of roughly, early 1900s, right? Depending on, and then, that kind of broke down, and then we had the Bretton Woods system. And then in 1971, we had the Nixon shock, right? And it was an analog of this, right? Because it was essentially, we were creating paper claims. Well, the dollars themselves were meant to be backed by gold. So dollars were meant to be paper claims on gold, right? And then we got into a situation where they were issuing more dollars than there was gold backing it at a $35 peg. And now it's like, okay, so now we've got the dollar system, but now we've got the separate gold system. But the same thing seems to be happening in the gold market, where we've got all of these paper claims against gold, and we've inflated the gold supply. And I'm just wondering what you think that's done to the price of gold, because obviously this is about supply and demand, right? So if you 10x the supply of something and everybody's sort of pricing it as if each paper claim is an actual physical amount of gold, I mean, that must have suppressed the price of gold significantly over the years, right?
I mean, that the allegation widely, believed by the gold community is that paper claims have suppressed the gold market, and commercial shorts have suppressed the gold market, especially at certain points in time. In fact, banks have gotten prosecuted for artificially suppressing precious metal prices. So that's been the long-standing allegation. I think what happens is that in the gold market, there is a referee, and the referee is the investor. And if the investor wants physical and doesn't want a claim on physical, doesn't want a paper claim, then they will demand physical delivery, and the referee will blow the whistle, and you'll get a sorting out. So I think some of that has had an impact on gold demand in the last 2 months, but it's kind of more of a long-term trend that I think still has to play its way out, and I think it's superseded by the bigger issue, which is that in the fiat currency market, there is no referee, or I should say, the referee's on the side of the winning team, which is the central bank, and he's just constantly allowing the central bank to incur penalties, meaning to penalize investors because they just keep printing more fiat currency. And they think of fancy acronyms to do that, and programs, and in order to sell it to the population, but they're really debasing the currency, right? And we all see it, and we see it every year. And all you have to do is look at the gold market, which has a referee, and the fiat currency market, which has a referee that's on the side of the issuing team. And you take a look at gold's performance against fiat currencies over 20, 25 years. You could do the bars, and in fact, Incrementum Research has done that, of the world's 10 most significant currencies, and trace them over 25 years. So 250 cells on that table. Gold rarely loses because fiat currencies constantly depreciate. And I guess the other thing about the referee is he gets to tell you how much they're depreciating by, and he's saying we can contain it to 2%, and it's actually 3%. But all the rest of us know it's 5 to 10, right? But the referee's biased, so he's telling you it's 2. It's the biggest lie going.
At Onramp, we believe that Bitcoin is the most important asset of the 21st century. The hard part is securing it right. There are shortcomings with keeping your coins on an exchange, but also with setting up your own self-custody arrangement. Onramp solves for these concerns. Our multi-institution custody solution maximizes security and minimizes counterparty risk, ensuring that your Bitcoin remains securely in your possession. and provides built-in inheritance planning to ensure your family is protected as well. Onramp provides peace of mind for your Bitcoin journey, whether for your whole stack or for part of it as a complement to your existing self-custody setup. For more information, check us out at onrampbitcoin.com.
Yeah, Peter, one thing I wanted to touch on there as well is you mentioned some investors feel that sentiment might be too hot for gold, right? It just breached a new all-time high last week, approaching $3,000 per ounce. But to your point, when you compare it to a system that is structurally flawed and you have a referee that is playing for the winning team, that's just human incentives. And there's really no reason to believe that will ever change because we've seen decades and centuries of this phenomenon, right? So I know in the United States, there's the Department of Government Efficiency that aims to contain some of the deficit spending, but in reality, I think it'll kind of fall flat on its face or stated objective of doing so, just because you pointed out there's so many entitlements, there's the interest expense that's ballooning. And so now, how do you think about where gold is currently valued? And just looking a year ahead or 5 years ahead, how do investors in your circles think about gold's valuation and what's to come there?
Well, short term, it's run a bit hot, and due to these delivery concerns, and could experience some volatility or even a pullback. I'd be completely comfortable with that. I think that it's clearly pointing the way to 4,000 within call it the next couple of years. Personally, I believe that that will be absolutely stoked the next time the Fed has to print. And I don't know what they'll call that printing. I don't know if it'll be called quantitative easing. They'll probably come up with a new name for it, but reverse repo facilities, whatever's required to keep this incredibly large debt bubble from bursting, they will do what's required. So I personally see that happening when the economy weakens off. Ironically, as a result of the government getting more efficient. The government's been the largest net employment adder in this economy. They start letting people go, I think you could probably see the economy follow behind pretty quickly. So if the economy gets soft and they really need to start easing, and they may need, some kind of relief program for people that are behind on debt payments or what have you, then I think gold is really going to start spiking. I think we're going to get into more of a hyperbolic type situation, more like what we saw with Bitcoin.
Can you explain something to me and maybe kind of overlay it on what you see going forward? Because I worked in the run up to and during the great financial crisis, and kind of the first couple of years of that, like you saw a big run up in the gold price. And then like from sort of, I don't remember exactly when it was, but about 2011 to 2012, we kind of, well, first of all, we had a big pullback in the gold price and then kind of recovered back to where it was before. But I think that took like 7-8 years or something like that. Yeah. At a time when interest rates were super low, the money supply was, increasing a lot. And so you sort of see something similar going forward, or potentially even more, more extreme. But it's just like, the question I'm really asking is, why did we see that pullback, during a period when you would have thought that gold would have been performing really well? Because if we're predicting that going forward, how do we know that we're not going to, for whatever reason that happens, see that as again?
Well, at the time, from what I recall, the Fed was so busy printing to get us out of the financial crisis that the game was really to play the recovery in other markets, real estate, bonds as they were lowering rates, stocks. Nobody saw the need for protection. So gold fell because people just didn't care, I think, in those days. And it was still a much smaller, much lower participation level type of market than it is now. So you really had an apathy towards gold during those years. And the game didn't get going again for gold until people really saw the printing around COVID. And, asset inflation, like everything was just running and you needed some gold to protect yourself. And that insurance bet has what's been steadily increasing over time.
Peter, you mentioned the participation rate. Can you talk a little bit about what that looks like today, along with how investors might think about their gold allocation compared to maybe a decade or two ago?
Sure. Well, I'll go all the way back to the 80s. It was really only gold bugs, serious inflation bugs that were buying gold. In the 80s, hedge funds got involved. And in the 90s, some institutions got involved with some core holdings. And, the whole time gold ownership was a lot higher in Europe than it was in North America. I don't think gold became a broader institutional asset class until the founding of the ETFs, which I believe was 2004. At that time, and we were kind of getting onto it at Sprott with the physicals, we estimated at that time it was kind of 2 to 5% of institutions bought gold, and usually it was at a 1% type of weighting. So I think that 2% is probably up closer to 20, 25, but it's still only at a 2, 3, 4% weighting. So it's still quite a low participation rate. I mean, there's less participation in gold than there would be in Apple or Tesla, for instance.
Obviously, we're involved in the Bitcoin market, and it sounds, it rhymes a lot with what we kind of hear.
Yeah.
Particularly with the ETF launches last year, and now the institutions coming in, and it's kind of even lower percentages in the institutional portfolios, sub 1% usually.
Yeah. The difference is with gold, it's taken 200 years, and with Bitcoin, it's happened in 5. All the adaptation is faster with Bitcoin, it seems.
Yeah. Do you find that, like among your client base, there's a clear demographic split, or do you find that like it's young and old, kind of evenly spread across your client base?
Do you mean gold or Bitcoin, or the comparison?
Gold. Yeah, because I always kind of think that, but I mean, this is just sort of, my own perception. It's not based on any evidence or anything like that. But it's younger folk kind of skew towards Bitcoin, and the older folk skew towards Bitcoin. I mean, to
Absolutely.
gold. Yeah.
Absolutely.
Okay.
I mean, this gets into the Argo business plan a bit, but traditionally you've been able to buy gold if you were a bank customer. And by the way, if you did, you got your face absolutely ripped off by the banks on their storage and trading costs. Or you had access to ETFs inside a brokerage account. And that generally defines the baby boomer generation and older. So gold was kind of known as an old man's market. And I think Bitcoin is generally a younger entrepreneurial market, 24/7 trading on your phone, that type of thing.
My grandfather, because when my grandfather passed away, so he left like a family trust and whatever, and I was an investment professional, and was asked to have a look at what was going on there after he passed away. No one really understood investment. And like, he had about 60% of the family's trust in gold.
Wow.
Yeah, and he actually grew up during the Great Depression, right? So I think that kind of potentially influenced him, like what he saw going on there, and also this 29, the stock market crash about then. Yeah, so it's just fascinating how far this goes back, and also how it's kind of a generational kind of thing where depending on where in history you were born, you
Yeah.
have a different view of asset classes and things.
But, I think we all learn that from experience. And to put my own into context, okay, I probably have about 40 to 50% of my assets in gold and precious metals and mining investments in one way or another. I've just grown up with it. I've been comfortable with it. They've done well, obviously. It's probably more than the average person would ever feel comfortable. I'm a Canadian, and our country over the last 20 years, from being kind of a par to par country with the US, has been run by a left-wing, left-leaning government that has absolutely gutted the productivity of the country. I mean, it's criminal what's happened. Our currency has gone from par to 69 cents. Okay. And I spend, when I travel, most of my time in the US or US based economies. I have been dramatically hurt by having far too many assets in Canadian dollars. Okay. I should have had more of my money in gold. So, in terms of putting it into context, all you need, and you take a look at those currency charts again, all you need is to have sat there in Japanese yen or Canadian dollars to understand why you're absolutely making a huge mistake if you don't have some money in gold. And it could happen. It could happen to the U.S. dollar one day. Although I think that's probably it'll never lose, or not for a long time, lose its status as the leader. But you'll just see it in inflation.
I mean, I can definitely commiserate. I mean, living here in the UK, it's a very similar picture. Even the so-called Conservative Party are, very socialist. And now we've actually got the Labour Party in, and they're spending money like drunken sailors that we just don't have. And,
yeah.
And it's going to end up, a train wreck. I mean, if you look at the FTSE 100, right, it's gone nowhere in like 15 years. And then you price it in gold and you kind of lost half of your money.
Yeah, exactly. But no professional money manager wants to show you that chart.
Yeah, that's for sure.
Yeah, Peter, appreciate you sharing where you sit personally. You said 40 to 50% in gold, precious metals, mining related investments. You mentioned that participation in the institutional community was 2 to 5%. I think you said a few decades ago, and maybe now closer to 20%. But it's still single.
But that's then got to be multiplied by their participation, which is again 2 to 5%. So it's pretty small.
Yeah. So how does that tie in then for, call it, the next decade? Then do you see a shift to gold becoming more of a strategic asset allocation because investors are predominantly more concerned about having assets closer to home, geopolitical tensions, trade wars, etc.?
Yeah. Look, the kind of risks that we sit with a deficit that is out of control, okay? Everybody, I think, generally accepts the deficit's out of control and the debt's out of control. Nobody seems to really think about how that's going to get solved. So let's just push that off for another day. But they've been happy to be in these other markets like bonds that have offered them negative real returns in the last 3 years, and stocks that are trading at probably their all-time highest valuation multiples. And real estate, which is starting to get hurt a little bit. Wait until you see how the government taxes that going forward, and you'll see some real pain. But generally, people have not felt the need to have gold. I think that investors are doing themselves a huge disservice not to have a hard asset, kind of scarce asset stockpile of at least 5 to 10%. And you can go to your favorite assets in that. You can go to Bitcoin, you can go to gold, which, by the way, I'm increasingly seeing as interchangeable assets. And that's why we built Argo, is to facilitate the intertrading between them. But you need 10% of your money in that just as a protection against what's been built up here, the imbalances that have been built up for 50 years and are now we're just starting to see the cracks, right?
Yeah. I'm starting to come around to the combination of Bitcoin and gold. I've been very focused on Bitcoin, but like I've been sort of partially convinced now because Bitcoin's so much more volatile than gold. And if you need a replacement for the fixed income portion of your portfolio in particular, or actually all of the portions that you mentioned, right? Particularly for older folks who are drawing an income on their portfolio or drawing down the capital on their portfolio, it's inappropriate to have 100% Bitcoin, right? Or a very high allocation to Bitcoin. But so I'm starting to think, and I totally agree with you. There's a asset manager here in London called Troy, and they have a strategic asset allocation of about 10% of gold in their portfolio.
Yeah.
And they, they get very high risk adjusted returns because of the diversifying effect of the gold in their portfolio. And then obviously over quite a protracted period, in the last 5 years, you've gotten sort of 13% comp as well. So it has some sort of cost you in terms of performance as well. So it kind of dampens the portfolio volatility at the same time as giving you kind of like equity-like returns. So yeah, I'm definitely starting to come around to the idea of kind of a, like you said, a hard asset kind of bucket in the portfolio. And I'd be advocating for, probably a quarter of the portfolio to look like that at the moment, at least.
Yeah, well, I've sat with so many different capital allocators and portfolio managers talking about this, and I think the old notion that a 60-40 portfolio, 40% bonds, 60% stocks can provide for the retirement and succession and to a family's net worth over time. I think that's just so old-fashioned now. First of all, bonds have basically become, in my view, certificates of confiscation. I mean, they're promising you, in many cases, a flat real yield, and that's because I use higher implied inflation rates. Stocks are great, but there's such a game being played with indices now and the Magnificent Seven that stocks could be great and you could still wake up one day and they'd be down 30% and nothing would have changed.
Yeah.
And so that 60-40 portfolio does not do you justice. And so you've got to have a separate portfolio that's kind of the counterbalance. And I think in that portfolio, you might have Bitcoin as your risk on, gold as your risk off. I would use very little cash or treasury protected inflation, tips, certificates. I'd use that in a small proportion. Maybe you'd have some real estate in there, some land. I just think that that's a necessity now to have that counterbalance portfolio.
Yeah, I totally agree with you there, Peter. The one thing I like to anchor back to, I think it was in 2020, Hirschman Capital put out a report about sovereign debt crises, and 51 out of 52 countries that exceeded, I believe it was 130% debt to GDP, defaulted in some way, whether it was an explicit default or just monetary debasement. So countries like Canada, the United States have been on that path of debasement for a while now. I think it became quite obvious in 2020 to many investors what's going on here. But to your point, there's still so much capital locked into legacy or antiquated portfolio construction frameworks with having 40% of that exposure to fixed income. So I do think both of our businesses are positioned well to welcome investors to allocate more of their capital to scarce assets in place of those certificates of confiscation you had mentioned. In closing, before we wrap up here, just want to share or get a little bit more context from you on Argo. I think what's fascinating is there's a lot of alignment between our brands. You focus on physical gold, we focus on the physical Bitcoin asset and security first and foremost. How did you and the Sprott team know in the early mid 2000s to focus on physical, and how has that ultimately informed the decisions that you've made with Argo?
Sure. Well, Argo's all about physical gold outside of the financial system, direct to vault. And our predecessor company, Sprott Money, was in that business, allocated separate bars and storage for investors, also sold coins and direct physicals. Argo is more of a digital representation of that. So efficiency, 24/7 trading, easy fills, easy access to the vault. Our pledge at Argo is to provide expertise to investors to know how to best buy that vault storage and where to best buy it. And I do think the big opportunity with Argo is gold is being tokenized, will have as its next big evolution a tokenization event. And I'm familiar with the work of the World Gold Council and the LBMA on this. There's no reason that you can't have a global custodian of physically verified and approved gold in multiple vaults that should be able to be locked on the blockchain and traded amongst investors. And no more need to move 747s across the planet. It just eliminates so many inefficiencies in the gold market, and it puts it much more on par with Bitcoin. And then for Argo, what we promised was to get smart about how you could take investors in between those two. So in between Bitcoin and gold, so that you could stay out of fiat as much as possible. And that's kind of the vision that we have at Argo.
Love it. How do investors that work with you think about their jurisdiction exposure? You mentioned investors want assets closer to home. You also mentioned that there's multiple vaults that investors could choose to park their physical with. Do you help, as part of your expertise, do you help your clients navigate those decisions and think about their exposures?
Yes, we will. And again, it's our pledge. We've started with an excellent deal with the Royal Canadian Mint. I mean, we trust our sovereign mint in Canada for storage. That's the premise on which the Sprott physicals were also built. I would say about half the investors in the US are comfortable with that, and in fact prefer it, out of the reach of the hands of Uncle Sam, so to speak. But half of them don't prefer it. Half of them would rather see Brink's storage in New York or Salt Lake. Unfortunately, right now that costs a bit more than our solution in Canada. So we will get there, but we want to have purchasing power. We want to strike a good deal for vaulting in the US. We also want to strike deals in the UK and Zurich and probably Singapore. So we want to have this kind of expertise to tell investors, you should consider this, you should consider this token. The tokens will probably have different jurisdictions for their gold, or you'll have a co-location token. So you'll take a global token and you'll swap it for $1 for taking your storage out of Canada and into the UK, for instance. So the system will be set up to be efficient, and we've just pledged to be at the forefront of it.
Excellent. And what type of investors are you working with predominantly?
Both retail and institutional. So institutional can negotiate a better deal with us for fully allocated physical storage. Retail, we're starting with a fractional, physically backed product. And we are creating a user base of retail customers now. We're launching in the US. That's live on the Argo website.
Awesome. Anything else that we didn't cover today that you think folks should be aware of?
No, but I think that people need to spend more time in this area and figure it out. And I think they need to have trading accounts and investment accounts outside of the financial system so they can have this kind of exposure.
Awesome. And Peter, where should people get in touch with you to learn more?
On the Argo website, please.
Awesome.
Yeah.
Well, thanks so much for the time. Really appreciate you coming on.
Okay. Thanks for having me.
Thanks for listening to this week's episode of the show. If you found the information valuable, please share the episode with a friend or leave a rating on your favorite podcast app. All the links we discussed in today's show will be in the show notes inside your podcast app. Before we finish, a quick reminder that Onramp Media is for informational and entertainment purposes only, and nothing should be construed as investment or legal advice. Regardless of where you are on your Bitcoin journey, we'd love to hear from you. Visit onrampbitcoin.com/contact to schedule a consultation with one of our private client advisors.